Older Americans are facing a problem. They don't have enough money to retire. According to the Federal Reserve Bank, the average 65 to 74-year-old has a little over $426,000 saved. While that might sound like a lot of money, the problem is that financial experts generally recommend saving anywhere between $1 million to $2 million for retirement. And when you look at the average retirement savings of $426,000, the numbers obviously don't match up. Lots of financial planners call retirement planning a three-legged stool because there are three legs to your financial plan, which are number one, having money from Social Security. Traditionally, number two, also having money from your pension. And then number three, you would have money from your savings and investments. The problem with this old method is, of course, pensions are a thing of the past. Social Security is drying up. And that leaves just your savings and investments, which is why things have changed over the last number of decades. So let's take a look at the new three-legged stool. The new three-legged financial stool looks more like this. You have your Social Security, then you have your tax-deferred retirement accounts, your 401k, then your IRA, and then you have your own personal investments. Now the problem is the average person, the average American, is putting a lot of weight on their stool right here on Social Security. And then they have everything else here and very little here. Now, if you really think about this from a stool perspective, that means you have a long leg here, and then nothing here, but a stool with uneven legs can't really stand. You have a long leg here, but you're not taking care of yourself here. I mean, if we take a look at Social Security, a lot of people talk about how Social Security is drying up, but that's really not the concern because, of course, the government can work with the Federal Reserve Bank to print more money and keep paying out Social Security checks. But the bigger problem that you'll see with Social Security is that Social Security is not keeping up with the growing cost of living. For example, in 2025, Social Security recipients are going to be receiving a 2.5% raise, which really doesn't keep up with inflation for the average person. Then if you say that Social Security is not enough, people will say, well, at least to have a 401k and my IRA, this is what's going to be able to fund my retirement. Except even the founder of the 401k has come out and said that your 401k was not intended to be your sole retirement plan. In fact, only about a third of Americans are investing their money outside of their 401k into things like stocks. Take a look. According to the Pew Research Center, about 1/3 of Americans said that they were personally invested in stocks, bonds, or mutual funds other than those held in their IRA or 401k in 2019. What does that mean? If you're thinking about retirement planning, your Social Security is definitely not going to be enough. Now, a lot of people assume and hope that the 401k or IRA is going to be enough, but generally that's not going to be enough either. This is a good place to start, but you also have to do this if you really want to be able to live a free retirement, have a free retirement time where you can do what you want and not have to worry about money, but that's going to require you to invest your money yourself. Now listen, I got to give it the disclaimer. I'm just a random guy on YouTube. I am not a financial advisor. If you have specific questions, please talk to a licensed financial in your area. And because we're talking about retirement planning like this, if you are looking for a financial advisor, you could check out my sponsor, Money Pickle. They have an amazing service where they can connect you with a licensed financial advisor. They'll match you with somebody who they think is a great fit, and you can have a free consultation with them. Now, just so we're on the same page, the Money Pickle service works best for people that have a minimum of $100,000 in investable assets through people that have $3 million plus in investable assets. So if you're looking for a financial advisor and you have money to invest, you can check out Money Pickle and get a free consultation with a licensed financial advisor. And I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Money Pickle, so if you use them, we will get compensated, but of course, there's no additional cost to you. Now, part of the reason why a lot of people don't want to invest their money is because they're scared of risk, and it's kind of understandable when you take a look at how people have lost money in the past. I mean, if we take a look at stock ownership over the last number of decades, what you'll see is that stock ownership peaked not in 2024, but back in 2007. And if you remember what happened after 2007, we saw the big 2008 financial meltdown where the stock market crashed, the economy crashed. I mean, it was a horrible time, but that left a bad taste in a lot of people's mouths, where I had my money in the markets, I saw the markets crash, and people got scared. They lost their life savings, they lost a lot of investments, and that scares people from investing. But what we know, if we take a look at markets over a longer period of time, is that yes, we go through recessions, yes, we go through market crashes, but despite that, markets have grown. decade after decade after decade for over a century. The three biggest pros with the 401k is number one, you get the tax deferred nature. Number two, you get a match from your employer sometimes. And number three is it's relatively simple to get started. Starting with being tax deferred. There are Roth 401ks and traditional 401ks, both which have different tax benefits. But the whole idea is once your money is in the 401k, your money can grow tax-free. Now, when you use a Roth 401k, you pay taxes before the money goes in, so you pay taxes today. But then when you pull the money out, which is hopefully when it's worth a lot more, you don't have to worry about taxes. You can pull the money out generally tax-free. With a traditional 401k, you don't pay any money in taxes today, so you have more dollars that go into the account today. Then this money can grow tax-free, and then when it comes time for you to retire, you can generally pull this money out, but then you gotta pay taxes. Now, some people like the traditional idea because they say when I'm 65 or 70 years old and I wanna pull the money out, I'm not gonna have an income, so my income is gonna be very low, so I'm gonna qualify for a lower tax rate. Other people will say, I wanna have a lot of income when I'm 65 or 70 years old, so I don't wanna do that. Not to mention the fact that I don't know what the tax rate's going to be in the future. We know that the government's borrowing a lot of money, and it looks like taxes will likely be going up. So you got to decide what's right for you. If it was me, I would rather go down the Roth route because I don't want to have to worry about those future taxes, and I want to have a lot of income when I'm older. Number two, this one might be the most unique benefit to your 401k because you can get tax benefits in places outside of your 401k, but your 401k gives you the option to potentially get an employer match. Now, this is going to depend on your company. Not every employer offers this, and every employer is going to have a different type of match, but this is kind of like a way for you to get some extra money out of your job. Now, if you're somebody that doesn't like your 401k, you don't want to invest your money in a 401k, but your employer is offering a match, ask them if they can give you that match outside of the 401k so you can invest that money somewhere else as well. But the whole idea here is if you invest certain amounts of money in your 401k, if you invest $1,000 a month in your 401k, maybe your employer gives you another $200 a month, $500 a month, maybe even a full $1,000 match. Just depends on the company, but this is what some people like to call free money just for investing in a 401k, and it's a pretty nice benefit. And the third is, of course, that your 401k is simple to use. I mean, when you go and get a job, your employer might give you a pamphlet that says do this, this, and this, and now you can start investing in your 401k. You don't have to worry about it because it is done through the company and it's nothing for you to really set up. Now, what about the opposite? What are the cons of a 401k? Well, the three cons that I want to highlight is you have limitations with your 401k as to where you can invest. Number two is the control when your money is inside of a 401k. And of course, number three are the fees, because yes, your 401k has a fee, even if you didn't know or think that your 401k has a fee. Starting with limitations. You have limitations on where your money can be invested. You're limited to the funds that are offered within your 401k account. You can generally not take that money and put it into whatever stocks you want, or take that money and invest it into real estate or into a business idea. You don't generally have that ability. You're kind of stuck with whatever funds are offered in your 401k account. Second has to do with control. And there are a couple levels of control here. You have governmental control, and then you have your own company control, because sometimes your company will use your 401k match as a way to keep you at the company for longer than you might like, because, well, your 401k is hosted through your company and they might require some certain vesting in order for you to receive all that money through your 401k. So it's a way for employers to keep you at a company, but also the government, because you can't always just go in and touch your money whenever you want. You have to wait until you are a certain age in order to access your 401k money. What does that mean? If you tap into your 401k before you're 59 and a half years old, you're gonna have to pay a penalty for trying to access your own money. And then of course our fees. When you invest your money into a fund, you're gonna have to pay fees. Now, that's generally not an issue, but the problem I have is sometimes people don't know what these fees are, and they don't know what the real cost of these fees are gonna be over the lifespan of your investing career. And so what I'd like you to do is, if you have a 401k, take a minute and take a look at what is your expense ratio. That's how you say a fee in the financial world. And that's what the fee is that you're paying for every dollar that you invest, for every year that your money is invested in your 401k. If you have a small 1% fee, you might wonder, how much is that going to cost you over the course of your career? And the small 1% fee could end up costing you close to 28% of your total investment value, meaning if you were going to have $1 million in your investment account, you might be paying over $250,000 in fees because of the small 1% fee, because it's not just a 1% fee that you pay one time, it's a 1% fee that you pay on every dollar that you invest, plus every dollar that you earn, for every year that your money is invested. So not only is your money compounding, but your fees are compounding as well, which is why it's so important for you to understand your fees. Now, your 401k is a great place for the average person to start investing. I don't care for 401ks. I don't use a 401k or IRA. I invest my money myself because I can get these benefits outside of a 401k. But this is where what I'm trying to say is it's a great place to start. But don't stop at your 401k. Just because you're putting some money in here doesn't mean it's going to be enough. And if you really want to have true financial freedom, you're going to have to invest your money outside of a 401k as well, which means you're going to have to put some money aside to invest. This is where it would be helpful for you to go onto Google and search a compound interest calculator to really understand how much money you need to invest and what types of returns you would need to see in order to build the wealth that you want. So I'm going to go with a couple theoretical examples here. Let's assume that you have 30 years for your money to be invested and you're going to get a 7% return on your money. Historically, the stock market has grown by 10% a year on average, but I'm just going to stick with 7% for the purposes of this example. Now, if you were to invest $100 a month for those 30 years at 7%, you would have about $121,000 when it comes time for you to retire. If you invest $500 a month, now you'd have closer to $606,000 when it comes time for you to retire. If you invest $1,000 a month, now you'd have about $1.2 million. And if you invest $2,500 a month, well, now you'd have around $3 million when it comes time for you to retire. Now, there's a few things that you can do. Either you can say, Jaspreet, I need to invest a lot more money in order to get the dollars that I want. How do I get that money? That's option number one. Or you can work to increase the type of return that you get. But you can't really change the time. I mean, we can't go back in time and start investing. So the two places that you can make a change is how many dollars you invest or the return that you get. Now, in terms of changing the return, this is going to depend on your financial education. Where are you investing? How sophisticated are you with investments? Can you read a financial statement? Do you listen to earnings calls? Do you want to keep up with the companies that you're investing in? Some of you are going to say, yes, I love that. Most of you are going to say, I don't have to deal with that, which is completely fine. But what everybody can work on is here. How can you invest more dollars? Now, first, if you're an investor and you want to stay up to date on what's happening in the markets, Market Briefs is a free financial newsletter that I created. If you haven't joined Market Briefs yet, it's free. It'll keep you updated on what's happening in the economy, the stock market, housing, crypto, and the global economy. And I got that link for you down in the description below. But this is where now, I'm not going to focus too much on this right here because I have a lot of other videos where I talk about this financial education. But if we talk about how do you invest more dollars? There's really two options here. You can either spend less money or you can work to earn more money. That way you have more money to invest. Because if you want to be able to invest more dollars, you got to have more dollars. Now, there's a limit to how much you can cut back on, and there's a lot of ways to cut back. I mean, the biggest expense for most people is where they live. So if you can move into a smaller home and save a few $100s a month, maybe even $1,000 a month, depending on where you live, that's money that you can put into here. If you're financing a lot of expensive cars, downsize to a Toyota Corolla that you can buy with cash, that we can take those monthly payments and invest it here. Maybe you sacrifice a vacation, maybe you sacrifice going out. You make some sort of financial sacrifices, that way you have some more money, which is great. It's a simple way to start. Not the easiest, but the simplest way to start. But then you might realize that you need more, or you want to do more, that way you can have more money to spend and also invest more money. And this is where you got to figure out how you can earn more money, because the key is to earn more money, not just so you can have nicer stuff, but so you can earn more money so you can have more money to invest. How do you get that more money? Well, maybe you look at getting a job change. Maybe you ask your boss for a raise. Maybe you look for getting a career change. There are a lot of certificates that you can take. You spend $500, $1,000, a couple $1,000 to get a certification. That way now you can get a new career. Or maybe you work to start a side hustle or a business. This way now you can earn some more money. It's not going to be easy, but the opportunities are there. And this is where you got to decide what's right for you, because if you really want to have a more free retirement, you want to have more wealth, well, there's three things that you can focus on. You can focus on how many dollars you invest. You can focus on how much time you have ahead of you, or you can focus on how fast you grow your money. I call it TRD, time, return, and dollars. The one factor we can't change is time, which is why you want to start investing sooner rather than later. But the things that you can change are dollars, how many dollars you invest, and the return that you get. Now, of course, you can work to be more aggressive with your investments to increase the return. But one thing you can also do that everybody can do is work to invest more dollars. Because the more dollars you invest, the wealthier you can become. When most people think of generational wealth, they're thinking, I own this home that's worth $600,000 with a $500,000 mortgage. Then I'm going to work to pay down my mortgage to $0. That way then I can pass down this house to my kids. But that's not what real generational wealth looks like. Real generational wealth looks more like this.